call the meeting to order. It is 9:02. I don't have a roll call on here, but I guess we should still do it, right? I don't see it on here. I miss it.
Might as well.
Okay. Present is myself, Fire Trustee Chair Eugene Dugan.
Leah Hayes, Police Trustee.
Walt Berry, board member.
Steve Marvell, trustee.
Martin Lewis, trustee.
Nicholas Hansen, Disciplined Growth Investors.
Gregory Williams, staff. William Johnston, staff, and we also have some people who are on the Zoom connection. If you could say your names.
Yep, Cole Jacobs here with WTW. Bob Bosner, Board Counsel.
Harrison, WTW.
Peter Damaris, City Auditor's Office.
All right. We have an agenda before us. Is there a motion to adopt the agenda as presented?
So moved.
Second.
A motion and a second. All in favor say aye.
Aye.
Any opposed? All right, the agenda is adopted. We have the minutes from November 16th, 2022. Is there a motion to waive the reading, or would anyone like to hear them?
Motion to waive.
Motion to waive.
So, second.
Seconded. All in favor?
Aye.
Any opposed? All right. Moving along, we have the board attorney update from Mr. Klausner.
Thank you. Two things. One, there was a bill introduced in the House in advance of the session, House Bill 3. And House Bill 3 is designed to eliminate any consideration of ESG in your investment decision-making process. It's a 49-page bill. Lucky for you, I read it already. And here's the part that matters. The provisions of 175, 185, and 112 are altered by adding the same language. It creates, most importantly for us, a new section 112.662, which says that when you make an investment decision, it has to be based solely on pecuniary factors, which means, is it going to make money at a reasonable rate of risk? And it says you can't sacrifice risk or return to promote a non-pecuniary factor, which in essence would be environmental, social order. Although you've always engaged in governance because that's about money, and been a securities litigation plenty of before. So that's really the issue. And every December, December 15th of every other year, beginning this to coming December 15th, we will have to file a report with the Department of Management Services, Division of Retirement, concerning decision-making in votes and adherence to the fiduciary standards required by the statute. It also will require the same concepts to be taken with regard to proxy voting. I think you've always based your investment decisions on achieving the highest and best return at a reasonable rate of risk, and everything else is kind of noise. Sometimes decisions will benefit some environmental or social practice because it's a good investment. As long as that, meaning it's a good investment, is the reason why you bought it or sold it, or voted a proxy, yay or nay, then you're in compliance with the statute. My view is that this is largely political in nature, and we'll see how the bill develops. It doesn't amend Chapter 518, which is the investment in fiduciary funds, which I think is interesting, but I think that this came out of the governor's office rather than a bill drafting. So we'll see where it goes, but I will keep an eye on House Bill 3 as it works its way through committee. Any questions on that one?
I have a quick question. So this
Yes.
applies to all local law plans. This isn't just the state board.
That was my first look, and it says any pension fund covered by Chapter 112, Part 7, which is us. And it specifically amends 175 and 185.
Okay.
So it's going to amend, it'll apply to all 400 and something municipal plans in Florida, as well as to the state retirement system and other state funds, various endowments that the State Board of Investment is responsible for. So yes, it will apply to Gainesville.
Steve, you had a question?
Adopted.
Yeah.
And I think there's a hard line.
It's not really a question, it's more of so they're essentially putting it in statute reminding trustees of their fiduciary responsibility to the plan that they are trustees and to the members that they serve. That doesn't impact us one bit, because we've always, and we will continue, at least as long as I'm on the board, invest to maximize return within our risk parameters, right? So I think we've had this ESG discussion at this level. And I think Bob's right. When those things rise to the top from a return, we're not going to say no because it has some ESG positive impact. We will do it based on our ability to maximize return for the members.
Yeah, I think what'll happen is we'll have to work with WTW when the form of the report is developed, assuming the bill is adopted. We'll have to work with them for what needs to go into the report, because as you know, you have fully discretionary managers. You don't make any decisions other than I hired this manager or I fired this manager. So to a certain extent, I don't know how this is going to work, because other than the State Board of Administration, which does its own investing, a lot of their stuff's done in-house. All the other pension funds in Florida are fully discretionary. Nobody's a direct purchaser of traded securities or alternatives. They all work through managers. So I think we're going to have some discussions with all of our managers to, if this bill is adopted, as to what the standards are that we're going to need reporting on to us, so that we can then transfer that to whatever state report is required. I don't think it's going to change your investment philosophy. I mean, I have always said, even in those states where you must use ESG factors required, like California and Vermont, those are two places where we have funds where there's statutes that require consideration of ESG factors, that I've always told them, number one concern, is it going to make money, and is it unreasonably risky, and is it in compliance with your investment policy statement? And as long as it is, then you don't have a problem either way. And the biggest confusion, I think, is going to be for managers, because there are products that are on the market. Now, the SEC is investigating some of them because they're not as E or S as they purport to be, or they're not making their investment decisions with those factors in mind. We're going to have to watch we're going to have to help work with them on making their investment decisions. Not whether it's a good or bad thing to buy, that's their call, but we'll have to make sure that they're aware of the law that governs the process. And we'll probably need to, since all of our contracts with all of our managers say you got to follow the law in Florida, whatever the final form of House Bill 3 is, we're going to have to inform our managers and obviously our consultant about what's expected. But I would certainly commit to WTW's review now. House Bill 3, just go to the Florida Legislature's website, or I can send it to call, whatever you want me to do. William, did I send you a link to this?
No, but I can find it and send it to Cole.
Okay. We're actually going to put together a little memo now, but reminding clients that, for all our Florida clients, reminding them that this is just a pre-filed bill, but it's something that warrants watching. I mean, it's the same language repeated over and over again on 49 different pages, but the part that I read you is the part that matters. So we'll just keep an eye on it. I always thought that your decision-making needed to be yours. Fiduciary duty is what's in the best interest of our members and beneficiaries and nobody else's. So if you adhere to that bedrock principle, I think you're going to be fine.
Thank you, Bob.
I have one other thing. I have provided we had talked about separated vested or terminated vested members. I drafted a policy, which I said I would do during the November meeting. And I provided it to William. Has everybody seen it?
I don't think it was included in the material.
If you could, it just basically gets to that issue that we dealt with before, which is, you know, what do we need to do? And in there, I want us to require in the rule or in our policy that nobody's benefit starts until they fill out an application. And if we have for the terminated vesteds that will come in the future, we'll inform them that. I understand we do have an application form which you like, so I didn't draft a different one unless you want something. But I would ask you to, William, if you could distribute the policy and we'll put it on our next agenda, which is, I think we're meeting in March, don't we?
Yes. I think
So
I may
put it
have
on the-
forwarded it to Steve to review because I wanted his feedback on it before we finalized it.
Yeah, I wanted some feedback on it too. That's really why I wanted it distributed, was to generate feedback. That I have no pride in authorship here, but I find that it's always easier to start with a something than a nothing. So this eases the intro to the discussion.
Yeah, Bob, my only issue is with the number of reminders that you had in your procedure. How many, you know, a year before and then another one right before. These are supposedly fully functioning adults. I don't know that multiple reminders of an earned benefit date is coming up is...
I always thought
You know
that
what I mean?
multiple reminders is for our benefit. There are cases that say that, you know, unless you have a specific statutory duty to do something, you don't have a duty to do it. So I think the liability is low. The question is, you just want to eliminate arguments before they happen. And having a policy that, you could even have a policy that says, we'll tell you when you leave, and that you're a fully functioning adult and we expect you to come back around, and the letter that you got, this letter, keep it, because it says here's your time to come out and come in and fill out an application. And if you don't fill it out, you're going to lose every month of retirement benefit that goes by where you haven't filled out an application. I mean, I actually litigated that question successfully for the city of Miami plan. And, you know, somebody waited 5 years to come in and got the month that she came in, so to fill out the application, and that was it. So I just like to have policies on things because, you know, people do leave. You know, there will be turnover in our pension office, and because what I'm seeing is a huge generational turnover generally in our industry, that I always like it if stuff's written down instead of relying on individual institutional knowledge. That's my only point.
Yeah, Bob, my only issue was the 2 times reminding them within a year of their date. That is a total of 3. I don't have a problem.
Then make it 1.
Yeah, I don't mind tickler like 6 months out so they can, with the application, quite frankly, so it's
Yes.
a no-brainer for them. It doesn't
Yeah,
change the date
and
it
probably
starts.
a self-addressed stamp or turn envelope. But
That's to those who keep their address current.
I think the real problem that I've seen, that when we have somebody who's gone for a significant period of time, and this goes to beneficiary issues too, when we have members who've been retired for some time and then a surviving spouse comes in, we don't have great contact information. And we ought to have a cell phone number and an email address for every single member of our plan, and an emergency contact number, because we've had trouble with much older retirees where they've been moved to a nursing facility or some other kind of adult extended care facility, and then we get information from the facility that the member died, and who knows whether there's a beneficiary or not. I've got that right now for Anchorage, Alaska. They have a share plan like we do, and the widow of the member's been dead for 20 years. The widow just died, and finding the beneficiaries, there was $250,000 in her share account that was from the husband's time, and it's from her investment return, that we had trouble finding somebody to give the money to. And now all the relatives are fighting over it because there's not a clear beneficiary form. And since the woman died from Alzheimer's disease, now the relatives are saying grandma didn't know what she was doing with the money. So what we're probably going to end up having to do is interplead the money, which means that's where you sue everybody who's asserted a claim, and the money goes into the registry of the court. Florida has a provision like that too, and then you just tell the survivors when it's over, call us and tell us, and the clerk of the court can hand out the money. So that's all. That's just, by bringing these things up as we have these experiences in other plans, I mean, your plan's very well run, excellent stewards of both your investments and the administrative aspects of the plan, but we like to share other people's problems. So to be sure that our internal controls are operating at an optimum level. And that's all I have, which is 19 minutes longer than I usually talk.
So, Bob, maybe I'll work with Steve to tweak the policy, and then we'll bring it back to the board next.
That's great. It's in a Word
Yeah,
format,
we have it.
so you can use
We have it. Yeah.
you can use track change to put the edits in, so I can, or marginal comments, so I can see, or you can take a pen to it, write the margins and fax it back, or scan it back to me. I'm happy to make the changes. I want this to be your document, not mine. I just acted as to prepare a working foundation from which you can then make this your own.
Bob, before the next meeting, is it permissible for board members to discuss this with Steve and William?
I think the board members can discuss it with William.
Okay.
If they're discussing it with Steve because of his
Right.
status as a board member, it then becomes a meeting.
I'll give you
I suppose you could notice it as a public meeting, and I'd rather you not have to do that. I think, William, you want to be the conduit
Sure.
for all discussions.
Okay, I'll do that.
Thank you, Bob. Appreciate it.
Good to see everybody, and I will see you here next month.
All right.
Bye-bye.
Be safe. All right, next up on the agenda, we have a presentation by Disciplined Growth Investors, Mr. Nick Hansen. We have to worry about the ESG with Disciplined
I
Growth?
was just going to go to that. No. Pending that bill isn't going to make much of a difference to how we do things. Fiduciary is purely how we invest. We're in the process right now of coming up with just because we're seeing this with a number of clients, a more formal disclosure and policy statement around ESG in particular. I mean, if you had gone back in time 10 years, this wouldn't have been, I don't even know if the acronym was quite mature yet. Would it have been something that we would have had to do? But at this point,
Social investing back in the old.
yeah, you had SRI, I mean, you had the anti-apartheid, you had, I mean, there's
That's when it started.
been a few versions of it at this point.
Apartheid is what caused this plan to split from the general pension plan in the late 80s.
Is that a fact?
Yeah. It was a single plan, and the city commission voted that they wanted to do the apartheid boycotting or whatever.
Right.
And the police and fire plan did not, so they split
Well, why am
in
I
like
not?
87.
I think I had heard something about it. I didn't realize that was the actual
Yeah.
genesis of it.
Yeah.
Yeah.
Wow.
When this discussion 30 years ago, or whatever it's been,
more than that.
40 years ago, generated some analysis, as I recall, because I was in the business tangentially, not a board member of a pension plan, but I was a manager. And there was an analysis, or at least a request for performance data using social investing, the baseline, and then comparing, I don't recall whether it was post facto or in the future, some 5-year period. Are you familiar with it? I presume those have been done.
There's been a number of studies
number
at this
of them,
point, yeah.
And my recollection is it was all depends.
Well, I mean, partially, there's no completely agreed upon definition of what constitutes ESG. And then there's also the distortions we've seen in the market of late mean that, most of the analysis initially was showing very healthy returns to ESG relative to the overall market, but that's because they tended to bias heavily into the big tech companies.
Yeah.
And now that that's begun to reverse, you're starting to see the reversal of the conclusions of those studies. So I think, you don't get that many data points. I think to say, is ESG going to drive returns? You can either do it philosophically, in our opinion, it would be no, it narrows your solution set.
Right.
So that's not going to enhance returns. In the long run, it'll, statistically or empirically depend on what the market's doing, and we just don't have enough data.
That's fundamentally the point.
And, Walt, just, to let you know, we get requests for information and background, and I've had to do presentations to the city commission about ESG
Yeah, I'm sure you.
several times over the past couple of years. It used to come up about once every 4 or 5 years. Now it comes up every year. And the one thing, aside from the difficulty defining it, because there are hundreds of factors you can consider, and how do you prioritize those? Everyone's got a different, idea of what they want. I've never been able to determine what they think will be accomplished by doing it. I mean, there are commissioners, and not just commissioners, other people that I speak to who think, if you buy a company stock, you're giving them money. Well, no, you're not. I mean, if you do an IPO, you are. If you buy an IPO, you are.
Well, even then, it's sometimes.
Right. You're giving the underwriters more than, but they think that if you do this, you're going to somehow enhance or contribute to companies who are practicing ESG. And that's just not the case. You're just buying stock from someone else who owns it. It doesn't really accomplish anything. If you want to support those companies, then they should go out and buy the products and contribute to the revenue stream and profitability of the company. That's how you do it, not by buying stock.
Well, and it also doesn't, if you're buying their product, necessarily conflict with your fiduciary obligation, which is the other half of that equation.
So
There's actually, in the appendix here, and I'll just show it since the topic's come up, just gets to which page it's on. You go to page 33, it's a thicker book than usual because we have a few slides. So this is a study worked on. I can talk about the sourcing a little bit more, but it's based on a few factors. One is that BlackRock and State Street are public, so they disclose data in terms of their assets under management. There's a Harvard study out there that studies how managers like DGI actually vote their proxies. And then there's, the product suite out there. We can go into consulting databases like Willis Towers Watson probably has, and look at all the funds and aggregate them up and make estimates for the AUM for the other two cited here, which is we have Vanguard, Fidelity, BlackRock, and State Street's equity assets under management, plus managers who vote completely 100% of the time in line with Glass Lewis or ISS, which are the proxy advisory services. And proxy advisory services, they sell their services to us. They also take money from both sides. They consult into the companies that they're advising on. So it's a little bit of a conflict of interest in my opinion. They take this though and they generate reports during proxy season. So once a year we go out there and vote your shares according to what we think are your best interests. A lot of firms will completely outsource that aspect of their fiduciary obligation to these proxy advisory services. Now, if you look at Glass Lewis and in particular ISS, they've been on M&A sprees. They've been acquiring little companies like crazy, and predominantly the last few years, it's been in the ESG space. And so they supplement or even, gratis into the reports we were already receiving, put their ESG recommendations as well. So if you look at the big four, BlackRock's the prototypical example because Larry Fink is always on TV talking about this stuff. But the other ones, Vanguard's backed off a little bit of late. But they are oftentimes voting their proxies or making proxy recommendations in line with some version of an ESG standard. And so if you aggregate up all the assets those 6 firms in some fashion are voting or control, you can see that line there is the equity assets being directly managed by the 4 asset managers I mentioned. If you then add on top of that the roughly $5 billion more, where it's 100% in line with those recommendations, you get to 38.2% of public equities, approximately. About 27.6% of public equities aren't voted. I mean, that's most retail investors, about 90% of them don't vote their shares. They invest in a Schwab or other vehicles and online brokerage typically, and they don't vote at all. About 9% of them do. And then there's a number of institutional managers who, for whatever reason, don't vote their shares either. I think the takeaway point you're seeing here, though, is that recently you've tipped into a situation where those 6 firms who are mostly voting in line and mostly voting with some level of ESG vote the majority of voting shares in a given year. 38.2 is bigger than 34.2. And it's going to go corporation by corporation what that implies in the bylaws, and the ownership is obviously differential across different companies, so this isn't a hard and fast rule. But this concentration of proxy control, the title of the slide here, has been something that's been very interesting to us, because we actually do go through, we use the proxy, we use ISS right now. We're looking at other solutions currently, but we don't vote their recommendations necessarily. We go through every proxy that we have to vote, and we always have, and we make a decision based on that proxy, largely for like board approvals. We rely on their due diligence, saying, is this person qualified to be a board member? I mean, that's a fairly, and maybe that will change, but that usually is, if we need to say we approve the auditors, generally speaking, we'll vote in line. For pay packages, for ESG approvals, things like that, that's where we deviate quite often from the advisory services. What we're looking for is a platform that will actually allow us to aggregate up all our different clients and vote them efficiently, which ISS and Glass Lewis do supply. There's not a lot of solutions in the marketplace. It's basically a duopoly right now. So we don't use their recommendation services 100%. We do use their reports for part of our analysis, but they are more and more starting to really push an ESG bent to how they do that analysis, and so it's become actually a little bit more of a lift. Luckily, we have 2 new analysts who've been doing a great job on this, and then we have to talk to clients about it. So we do have clients who are, you mentioned state of California, for example. We don't do business with the state of California right now, but we have other clients who do have a very pro-ESG tilt to them, and we have to explain that we've always done governance. We vote against a ton of corporate compensation packages. On the social side, we probably would define it a little differently. We do look deeply at the cultures of firms, because we believe that a healthy, thriving culture contributes to employee engagement. It allows them to drive better productivity out of and better innovation out of their employees. And so we spent a lot of time on culture for the entire existence of the firm, definitely since I've been there, since 2006. And then on the environmental side, I mean, largely what we point to people and say, look, if the company's going to get sued out of existence or spend all their money on an EPA Superfund site, probably not a great investment long term. And since we invest for such long stretches of time, we need that, quote unquote, sustainability in a real fashion. We need economic sustainability, and there are liability tails to a lot of anti-environmental things, and we consider it in that fashion. So in some aspect, we are thinking about those factors, but through our own lens of long-term investing and through the lens of a fiduciary obligation, which is 100% the primary lens that we look at everything with. The last thing I'll say here, and then I'll move back to kind of the regular flow of things, would be we have to cohabit a lot of investments, our equity investments in these companies, with these big 4 managers. So if you look at a lot of our companies and you go through and say, who are the top 3 managers invested in this stock by percentage ownership, it's not uncommon to see 2 to 4 of these guys as one of the top 3 owners. And so it's the reality is if Larry Fink calls or one of his deputies, people usually pick up the phone. They've been more active on that front of late. And you're seeing a lot of ESG reports coming out of companies. You're seeing them burn up more corporate bandwidth and C-suite time on this, and oftentimes nominate C-suite positions against the ESG project. DEI, of course, being one manifestation of that within a company as well. And so we've had to question fairly rigorously, and part of our policy statement that we're hoping to publish sometime this year is not only going to be what does this mean for people like you guys, for your plans and your assets, but also what does it mean for our voting policies, our company engagement policies, because it used to be a much more, we look at it from a fiduciary lens and everyone else can kind of do what they will. Now we have to actually provide our feedback to, when we talk to the CEO, or we talk to the CFO or the Chief of Human Resources or someone like that, the board, we have to say, well, this is what we're looking for, and these are our criteria, and then we have to basically stay in line with that. So it is becoming a more pronounced, I'd say, issue that we're spending, unfortunately, more of our bandwidth on now as well. But whatever comes of your build out here, I think you can rest assured that we will always be looking at this through a fiduciary lens.
No idea how to control proxies.
I don't know what happens to that longer term, because it's, I mean, for the longest time, passive investing meant you were passive. And in my mind, voting the proxy is an activity that's active. And so if you say, I'm passively investing your money, but I'm also appropriating your proxy and using it for corporate purposes, that also inherently seems like a breach of fiduciary duty right there. And, you know, misrepresentation of the product. But, I mean, I don't run BlackRock, so.
Well, the lower echelon of BlackRock doesn't understand it either.
I sometimes get that impression. All right, so I'll flip back to the beginning here. I will not spend too much time. What I do want to do is highlight a few things. The first is a firm update. You'll see 4 items on there. The top item, Rob Nikoski, who I don't know, maybe I can bring him with for one of these meetings, because he hasn't traveled down south, but I know he loves Florida. And so if I can persuade him one of these years. Rob Nikoski's been at the firm since 2003. He came in from US Bank and prior to that at Piper. So he worked at Piper as basically a sell-side equity analyst. He was at the Minnesota Fed for a brief stint. Was briefly on the sell side, which I think he lasted for 3 years. He calls them the longest 10 years of my life. And then after that, he was a portfolio manager at US Bank for, I believe, a small cap product. I'd have to cross-check that, I'm not positive. And then he came over to DGI and has been a portfolio manager at DGI for over 20 years, or roughly 20 years now. He has now taken on the title of CIO. Years ago, Fred Martin, the founder of the firm, held that title. For the last several years, we have not had a CIO. We've just had 3 and then 4 lead portfolio managers, of which I am one. Jason Lima would be the one who was recently promoted up to lead portfolio manager as well, so there's 4. Rob now assumed the title of CIO. Functionally, nothing internally has changed. We joke that except for the lead PM title, which means you can veto investment decisions, most of the titles at DGI are to externally explain what I do at work every day. So there's not functionally really any difference. Rob has been instrumental in architecting the investment process for years and years now. He was actually very much a mentor to me. Before I came to DGI, he was my initial point of contact, so I'm really just thrilled that he's taken on the title. And a lot of it is more, again, telegraphing to people outside the firm that, you know, time marches on. Fred will be down here tomorrow talking to the city. But he's 76 years old now. He's still at work every day and fully functioning. But it's letting people know that he's not the sole person at the firm. And that's been the case for quite some time. But I think the messaging is very important. And Rob has really been the one who has been driving the process, and in many cases driving, you know, some of our corporate client relationships, and then a lot of the business decision making as well. So, well, there's a new title assigned here at the firm that doesn't mean much. Internally, everything is going just as it's gone, which is, knock on wood, after the COVID stretch, very smoothly. The other one, if you may recall, Robert Buss has been down here in years past, and he was tragically hit and killed by a freight train in the summer of 2021 while biking home from work. It was an immense cultural blow to the firm. He was a pretty amazing personality, a very happy guy. Left behind a wife and 2 grown children, whom we've actually spent a lot of time helping out and making sure they're okay as well. We only have 20 people at the firm, and our employee tenure usually stretches better than a decade, so we get to know each other really well, and it was a very, very tough blow. We'd been at DGI since 2000. After some time, we've hired Nick Iceland. He actually used to work in consulting, and before that he was actually a small cap analyst at a fund. He's right around 40 years old. He's got 3 kids, and he's based out of St. Louis, Missouri, so he'll be our first remote employee, even though he's up in the office pretty regularly, just because we prioritize in-person culture so much. So he'll come up and do these multi-day stints where he'll stay at the office. I've had him over for dinner at my house just recently, you know, just to make sure that he's fully embedded within the culture of the firm, which, like I said, both in our companies and our own firm, we prioritize. He'll be in charge of being the director of institutional relationships here. You know, there's a degree of going out and talking to new prospects, but more and more as he learns the client base, I assume he'll come with me on one of these trips here soon. it'll start to learn our clients and be a good point of contact for day-to-day resources as well as your primary customer servicing contact. Finally, two last items. One, we conducted another equity transition at the end of 2022. We sold Fred Martin sold stock to 3 existing and 4 new shareholders at DGI. If you recall, DGI is 100% employee owned. We're going to continue to be 100% employee owned. That means to own stock, you have to be a full-time employee at DGI. So if you're not functioning as a full-time employee, you're not allowed by the buy-sell agreement to own stock in the firm. And there's very robust protocols to buy that stock back as soon as you move to either a part-time, retired, death, disability, etc. status. So now Fred will have moved from roughly 33% ownership down to 22% ownership. I was a buyer of stock. I was actually the largest buyer of stock. 2 others, Jason Lena, that other lead portfolio manager I mentioned, and Peter Reiki, our chief compliance officer and chief operations officer, also bought stock. They were existing shareholders. Then we have Beth Miller, Cassie Mau, let me make sure I get everyone here, Evan Almaroth, and who am I forgetting? Oh, Katie Brever. So 4 new shareholders there as well. They each brought roughly a point. I believe Cassie bought a half point of stock. So we broadened out the shareholder base. That's a very big deal. It speaks to our long-term goal to be a 100-year firm. We just are coming up on 30 years here, so we're almost a third of the way there. And then finally, the Outlier Fund. This is a limited partnership. It will be small in scale. We're capping the assets at $300 million. This is basically still going to work, continue to be small and mid-cap equity specialists. Our Nick ran a study. It looks like we're one of, I think, 13 in the country that has over $1 billion in assets are independent and are small and mid-cap equity specialists, so we're starting to be in a pretty narrow group of people. The Outlier Fund will be a small and mid-cap product, a blend of the two, and it will be a concentrated set of portfolio holdings. It's going to be a smaller one. Our hope, we would not do something like this, which is we consider an access point to our core investment philosophy. But what we're going to do is, with that more concentrated portfolio, one of the biggest sources of potential gains that we've identified within small and mids, and I think I talked about this in years past, has been how we weight portfolio holdings. Given the concentration in this portfolio, that's going to continue to help us internally with that project and also provide a higher return profile for select clients. So we're targeting a 20% per year annualized return with this product. It's going to be enhanced volatility because it will be more concentrated and we'll be investing in higher return names. But by and large, it will likely be an overlap with existing names. It's one of the reasons we've capped equity investments into the product, so we don't want to crowd out opportunities for small and mids. It will also have a 3-year lockup period because of that volatility. So it's a pretty narrow select investment, given that we have between $4 and $5 billion in equity assets under management now, depending on what the market's doing in any given day. The $300 million cap will keep it pretty small overall relative to the firm, and it will have an incentive fee on top of that, which is weighted pretty heavily relative to the industry in the client's favor. So the break points would be no incentive fee under 10% returns. Between 10 and 20% returns, there will be a small incentive fee, and then above 20% returns, there will be a slightly larger incentive fee. But what we've done is stacked that so that at any given rate of return, it's actually a very competitive overall charge to the client. I don't know that necessarily fits your investment philosophy here. I provide that information more in the interest of disclosure and firm incentive structures.
You said it was an LP structure?
Correct. We're targeting an April 1st launch. We've got a partnership agreement that is draft, so we can show it to people. But it's been a very interesting learning process for it as well. We have 2 partnership structures already at the firm. This will just be the 3rd on top of that. So pause there. I don't know if there's any questions on those 4 items. Otherwise, I'll move into kind of the market and the portfolio.
Just the $300 million seems relatively small for a firm,
Well,
for a fund.
It is small. Part of it is, given the scale, there's a bunch of different considerations. There's analytical bandwidth. We have limited analytical resources within the firm, so we have to steward them properly.
Right.
We have, if you invest in companies in the scale we do, which is in the small and mid-cap space, they can only sustain, we don't want to own 20 or 30% of the company. And there are companies where we own more than 10% of the company, and you start to get into disclosures and liquidity challenges on ownership positions like that. And then finally, if you actually achieve your 20% target, 300 million can be a lot more pretty quickly. So we have to preserve our ability to function not in the face of 300 million, but in more money than that.
That's cool. I mean, it's a good market. It's a good market to have.
Yeah, and we actually have to talk to clients about that because we have, I think the expression in the industry is a drawdown fund where you go marketing with it when the market's down so that you can put good numbers up. And so we have to talk to people about that fact as well, that this is, you know, we've been incubating this for a while. We're lucky that the market's down right now because it's a great buying opportunity given the value we're seeing in the marketplace. But we're not just slapping something together to try and take advantage of a market low. So I'll move on then. Performance is the next section here. So this is, as recall, we spent some time working through this and making sure we could disclose in this fashion. We're going to show you two different kinds of performance, the dollar weighted and time weighted. The first here is the time weighted, which is typically how most investment management firms talk about their performance. The time weighted performance for your account as of year end, and the next page will be year to date. You'll see that so year to date means just the full year for 2022. So you see that your small cap portfolio in 2022 was down 26.61%. The small cap index that we benchmark against, the Russell 2000 growth, was down 26.36%. So we're marginally underneath it, but roughly in line. The stock index, the broad stock index, which we use the S&P 500 for, I mentioned, or I think I've mentioned in the past, that's usually give or take about 80% of public equity capitalization out there. So this is, and it's usually larger stocks. So the big tech companies, depending on how you slice that definition, but if you say the top 10 tech companies, they got to be about a third of the S&P 500 beginning of 2022. So that was down 18%. The since inception performance you see in the bottom line, so that's 28 years as of year end, since the apartheid split. So you've got an 11.25% annualized performance versus 7.3% for the Russell 2000 growth and 9.94 for the S&P 500. I'll actually come back to the numbers relative to each other later in the presentation here to talk about some recent dynamics in the marketplace that we think might impact the go-forward numbers. Year-to-date performance, you'll see on page 6 there. Year-to-date, this is as of the 15th when we PDF'd these up, and so this matches with that. I got in so late last night I couldn't run the year-to-date numbers before I came in for the last week here. Is 14.77% versus 12.23 for the Russell 2000 growth and 8.25% for the S&P 500. And again, I'll come back to those later in this presentation. This next slide is the one that we actually think is very important because there's a lot of managers who disclose really good long-term numbers. It's because they barely had any money they were managing when they generated the good part of the numbers, and then as soon as they got assets, they generated the bad part, and they still have slightly above average. The dollar-weighted performance is, we just call it the money-made slide. You guys started in 1994 with $9 million. You've taken out $35.7 million. There's been appreciation in income. This nets it out of $51 million for an ending market value of $24.3 million as of year end.
That's a significant number.
It's one of those things, especially we talk to some of our smaller clients. We have some high net worth, and then my parents, for example, are invested with disciplined growth investors, and if you show them percentages over a stretch of time, it's interesting, but it's not what they go and buy groceries with. And so being able to say, this is what you started with, and here's how much money we made you, I think it's a really impactful thing. We really like, because our clients tend to be so long-term, we really like being able to show that. So what I'll do here in the next few slides is I just want to recap the last few years. I won't spend long on it because we've talked to you guys every year and you're aware of what happened, but I want to frame kind of the next part of the presentation there. So 2020, obviously we had COVID. Because COVID was such an interesting dynamic, both in the marketplace, if you look at slide 10, but also in the end markets for many of our companies, like we were invested in JetBlue and Royal Caribbean, for example. And Royal Caribbean actually, and several others, dropped down so far, Nordstrom's was another one, that they actually entered small cap territory. And so that was a very, very interesting dynamic that usually what we try and do is incubate small cap companies until they're mature enough to graduate into our mid cap portfolio. To have them go in a reverse, we had to come up with new vocabulary for it because we'd always call it graduating to our mid-cap product, in which we will continue to hold them in smalls, because we want to make long-term investments, but then we have we call it a tweener, a stock that's invested in both our small cap and mid-cap products.
Demoted didn't work.
Demoted sounds a little pejorative, yeah, we came up with a lot of jokes around what we could say that was. But it did avail some great opportunities. Because we were so focused on making sure the portfolio was robust against a fairly novel phenomenon, you can see the window there where the market was truly down was fairly brief, and by the end of the year, the market had recovered up to nearly 20% up. The Russell 2000 in particular. The dynamic we did see through the spaces was the 2000 and several of the others. You can see it dropped further, but then it overtook both the mid-cap and the large cap space to finish the year on top. And this is a broad market dynamic, not necessarily reflective of your portfolio. But the small cap space was actually the first one to peak and roll over, then the mid-cap space, and then right at the beginning of 2022, the large cap space, the S&P 500, finally rolled over and started declining from its peak as well. So in 2021, we had the valuation excesses, as we call them. There's a lot of different ways to slice this. One study that I haven't been able to finish yet. I have, for those of you who are here tomorrow, the mid-cap space. I have this study completed, do not have it for the small cap space yet, but it's showing the number of companies trading above a 10 times sales ratio, which became historically dramatic. The last time we saw it was 2000. Here I use the PE ratio, the forward PE ratio, so how much money you're paying for the forward 12 months price to, or for the forward 12 months earnings. You can see that it spiked up to historically pretty high levels during 2020 and 2021. This posed challenges in our portfolio because we are very valuation sensitive. We're trying to buy companies that are fundamentally growing, but we do not want to buy or stay invested even in companies that are overvalued. And so what we had to do is spend a lot of time rotating capital out of names that we fundamentally still liked the company's prospects, but the price we were paying for that was much too high. And it was an immensely frustrating time professionally for me, because every time we'd sell a stock because of valuation considerations, it would continue to go up. And so we felt like we were working against ourselves all year, and just had to have faith in our process throughout this, that this is doing the right thing. It has started to pay off, and we believe it will continue to pay off. The next page, page 13 here, actually shows you, we haven't done this before, this shows you every investment decision we made within our small cap product during that time stretch. So there's a lot going on here, and I won't necessarily dissect it fully, but the line you see, the gray line going through there, that's the forward expected return. So this is the return we expect from our portfolio over the next 7 years, which is our modeling horizon. And that's the weighted average of all the stocks expected returns within portfolios. We do company by company analysis and then aggregate that up into a portfolio expected return. If you look at, we target a 15% return, and if you look at that late 2020 into early 2021 stretch, our expected return, our forward return in the portfolio was less than 15%, which is our target. And consequently, you see that many of our buys in black are above that line. That means that at the point of purchase, that stock had a higher expected return attached to it than the portfolio. And most uniformly, except for one over to the right, three actually, Ping, Powie, and Stratasys, are the oranges, which are the sells, which means the whole time what we're doing here is just selling stocks that had a low expected return, sometimes negative, saying we believe this stock is going to lose money over the next 7 years, and then going and buying higher expected return stocks. What you've started to see now, and I need to roll this into this year, is our investment decisions now you're seeing more of a blend of sells above our portfolio expected return and buys below sometimes our portfolio expected return. The reason you're seeing that now is because fundamentally we believe in the solid prospects of most of our purchases. Even if the expected return isn't above our portfolio, it's still above that hurdle rate. And so what we're trying to do is narrow the range of outcomes in any particular company. And so we're able to make buy and sell decisions based on the fundamentals of the company again. Whereas for quite some time, we just had to sell overvalued stocks and find good companies to purchase on top of that. The next page, 2022, this is the part where we get into kind of slightly novel territory here. We started out on slide 15, page 15. These are the Bloomberg U.S. Aggregate Bond Index, so this is the total return annually of a high-quality bond index. and it goes back in time, I believe Lehman ran this for quite a while. Barclays was in charge of it for a little while, so it's passed through several hands of ownership. But this is usually a nice kind of sort of like the S&P 500 one you can point to say what's the bond market doing. 2022, there's another one we've looked at, but this one was somewhat unprecedented because in the same year that the stock market was down a lot, so was the bond market. So that was, especially for investors who are invested in balanced portfolios, if you do the 60-40 approach, it was a pretty brutal year. And people weren't used to that. We do manage some balanced money as well, and you know it's been a very, very difficult year. But given the rise in interest rates, we would expect it in a more normal environment now. We have been tilting towards equities in our balanced portfolios. Now we are saying, you know, you can actually, as you're talking about earlier, you can get a decent return to the bond market again. For a while, it just wasn't worth it. But that rate environment, whether it stays higher for longer, that's going to be a very interesting challenge, not just for the bond market, but for a lot of investment strategies that are based on low interest rates. Usually that means, are they taking advantage of leverage? Are they taking advantage of business models or valuation models that rely on a very low interest rate environment where the bond market isn't really providing much competition for other investment classes? Here you see, this is where I start to get into the relative performance piece that I referenced earlier. You see the 4 lines on this chart, and the y-axis, that 5 times up to 45 times, is going to be the forward price earnings multiple, and that's the price you pay for the next 12 months earnings on these stocks. The S&P 500 is the large cap space, that's the black line. The S&P 400, which is the mid cap space, is the dark gray line, and then the S&P 600, the small cap space, is going to be that light gray line. In each of those cases, I mentioned the S&P versus Russell. The S&P requires profitability to enter the index, so you have to have a trailing 12 months of profitability to be included in that index. So there's a little bit of a caveat attached to that. Then we have what's called, colloquially, the mega cap 8, and Ed Yardini, he's a market economist out there. He coined this term, and during the kind of the valuation peak, put Microsoft, Apple, Amazon, Google, Facebook / Meta, Tesla, Netflix, and Nvidia, because they all had very, very substantial, I believe they were all top 10 by market cap companies. Valuations attached, they were all tech companies, so you had a very high sector concentration risk percolating into the indices. And you can see that the valuation multiples assigned to these very, very, very large companies was huge. Like I said, they became probably about 1/3 of the capitalization in the entire S&P 500. And so if you took the weighted multiple for those 5 companies, you can see that in the orange line there. So when I said that the small and mid cap space is actually, I mean, this is, again, this isn't the portfolio particularly, even though we'll get to that, has actually already come in quite a lot. It rolled over earlier than the S&P 500 in these mega cap stocks. It's near historical lows, which is kind of confirming what we're seeing in our individual company valuation work. The S&P 500, which is again usually around 80% of market capitalization, is at a more historically average level, but a lot of that is still being driven by these large tech companies because they are a substantial part of the index and they pull that overall valuation multiple upwards. Teasing the two apart is a very, very difficult challenge that S&P charges you a lot of money to get the data for, so I haven't done that here. But suffice it to say, we think that the forward prospects, just because of the growth, I mean, if you look at the regulatory environment, you look at the fragmentation of the regulatory environment, I mean, between Europe, China, the US, and others, and the initiatives that are being undertaken in each, I think there will be substantial growth headwinds for many of these companies. And a lot of their valuation depended, in my opinion, on supernormal growth rates and low interest rates, meaning you had almost nowhere else to put large amounts of money. So if you look at the amount of money that could come out of these companies, which represents trillions of dollars if the valuation comes in, those companies by themselves are probably a larger aggregate market cap than the entire smaller mid-cap market space. And so if you talk about money sloshing around looking for a home, the bond market's probably going to be a destination for some of it. I don't think on just a strict market-wide valuation front, there's a big argument to be made for substantial outflows on a relative basis coming out of the smaller mid-cap space. But I think there's going to be a lot of pain still on a go-forward basis coming out of the S&P 500. And the index funds in particular, because you can't rebalance an index fund based on overvaluation. If there's a valuation bubble, the index fund participates in that pro rata. And on the back side of that, the index fund participates pro rata. So in the run-up here where passive investing really came of age the last 10 years, basically all the index funds experienced was positive momentum in their investments, and to a degree relative outperformance in a lot of cases, because the largest cap names where they were predominantly invested were the ones that were driving the market, as you can see here with the valuation attached to those mega cap 8. So moving on to there, 2023, we're not too far into the year, it's already been fun. One is the recession fears. I mean, that's usually, I narrowed in, we said, there were a lot of different factors in play, creating uncertainty in the market last year. Those have started to resolve into very particular fears. If you see here's the leading economic indicators, which the gray areas are past recessions in the US. When the leading economic indicators drop to a level they've hit, they're represented by the dotted line, which is negative 6% or so. By and large, that's been a pretty good leading indicator over the past 50 years of a pending recession. There's a little bit of an odd dynamic to this one because of COVID. You see it with the jobs market, you see it with a lot of the data that the Fed's relying on to try and fight inflation, which is that unemployment has not gone up. There's a few, they aren't necessarily captured within the LEI index here, but there's a few indicators that wouldn't suggest we're on the verge of a recession. There's been still a shift coming back from the goods economy back towards the services economy. So as people go to restaurants again, as people go and take that cruise, as people fly in the airlines again, hotels, those industries have been hiring hand over fist, while you're seeing all these headlines on tech layoffs. And so you really have two almost different job markets, like roughly sliced as the white collar and blue collar job markets, that are experiencing very different dynamics right now. And there's data that suggests actually even within the white collar, the tech workers space, that a lot of those layoffs aren't posing much of a challenge because those workers who are laid off are snapped up pretty immediately by other competitors. We'll see if that comes to pass. That's more an aggregation of anecdotal data, so I can't put it in a chart. But the job market does still seem robust. The fear is, of course, that continues to drive inflation forward. I don't know. I speculate on the macroeconomy. We'll see what happens. The thing that's interesting to us, though, is because the large cap stocks are exposed to the macroeconomy. It's this next slide, slide 19. So this is where I get to kind of the heart of what we're seeing in the relative valuation or the relative performance piece. If you take the S&P 500 and what you saw back on that mega cap slide, so slide 16 if you want to flip back and forth, is that the valuation multiple attached to the S&P 500 is probably still around 17 times, whereas the rest of the public equity space has gone down to about 12 or 13 times. Now, if you took this multiple assigned to the rest of the equity space and you assign it to the S&P 500 tomorrow, that would mean that the S&P's trailing 3-year return would go from a 9.9% return down to a 0.7% return. You didn't change the earnings at all. All you did was change the multiple assigned to them and then spread that penalty out over 3 years. That's what would happen to the S&P 500 performance. You took the 7-year S&P 500 numbers, and this surprised me. There's always still things about compounding that surprise me, even after all these years. The 7-year number actually goes from a 13.3% return on the S&P 500. It drops to a 9.1% return. And again, that's just taking that same earnings number and just penalizing it from a 17 times down to that 13 times. And so it's just that number I get from the average of the other two spaces. And so what you see with DGI's small cap investments right there is you see the trailing 3-year number. This is based on our composite overall, not specifically your account, though your account is very close to our composite, which is the aggregation of accounts. And on the 7-year number, you see that we're slightly underneath the S&P 500. Now, how that valuation differential eventually trues up, and whether it trues up is an open question, of course. But if you look back at slide 16, you'll see that historically over time, the S&P 500, the S&P 600 have generally traded at roughly the same forward PE multiple. The divergence you've seen in multiples, which has largely been driven by these large tech companies, has not come in. It's actually the gap that's opened up between small cap and large cap is historically large. That doesn't tell you that it's not sustainable, but it does tell you that there's a lot of factors we don't understand which drove that convergence of multiples for some time, and we can point to one confounding factor, which is these large cap tech companies experiencing, for a large cap company, historically very, very high earnings multiples. And so we like to point to that for people because the S&P 500 is a hot topic. When people say, how is the market doing? Usually that means they're talking about the S&P 500.
And what we try and do here is create a little space and saying, specifically within the space we invest, we see a very different market dynamic than the stock market that you see in the headlines. And then on top of that, within our space, we have our own very specific portfolio, which drives our insights and gets me to our next section here, which is what we expect for the next 5 to 7 years. So in the next 5 to 7 years, we say fully invested here. That's a little bit of a metaphor. We're always usually fully invested. We're not a manager who tactically goes to cash during points when we get scared. We try and find good investments, and we try and stay fully invested the entire time. You can find people who can manage cash for you a lot more cheaply than we can. We currently have the highest expected returns in our portfolio since 2009. So if you flip to slide 22, this is the chart over time. So this is a fun one for me because I started in 2006, and one of the things I realized, we've got an internal joke that it's my highest value add at the firm, is that I hit copy and paste. And I came in and we had models for every single one of our stocks built, and no one was saving them. I mean, we had them saved off the current versions, but we weren't archiving them over time. So one of the first things I did was, at first once a quarter, that's why you see the chunkier resolution on the graph initially there, but then once a month. And eventually we moved to once a week, and with our new software implementation right now, we're hoping to move to basically a daily or real time. But we've been archiving what we expect from our portfolio and what we expect from every single one of our companies. It was initially just a part of our process improvement that we undertake every year. We were trying to look back and say, how were our predictions? We said this stock would do this. What did it wind up doing, and where were we wrong? And we're really regularizing that process more and more every year. But it also allowed us to create this chart, which shows the expected return that we saw in the portfolio over time. And with our small cap product, the expected return we've realized within the portfolio in average times tends to be reasonably accurate. In down times, we've been fairly accurate. We haven't been perfectly spot on. One of the things I'd like to do next is overlay our realized performance on this chart, but it does correlate fairly well. We have over time, depending on the valuation environment that you start and end in, which we're not good at predicting. We try and predict the fundamentals and then assume a reasonable valuation. But we have seen these returns. So right now, because of this magnitude of the forward expected returns we're seeing, which is, again, we look at every single company, we look at its opportunity, we model how it grows going forward, we try and be very accurate with that, and then we assume that people in the market will pay a reasonable price for that company over time. That's what gets us to this point. So currently we're seeing over a 20% expected return in the portfolio. And that's just the biggest assumption inside of that is we just have a normal valuation environment in the market 7 years from now. But we think the fundamental growth in the companies, which is largely, I'll flip to the next slide here, you can see on slide 23 in black, that fundamental growth, we call it intrinsic value growth, is the stable and most reliable source of our expected returns over time. And so what we look for is how quickly does the company grow. Oh, one very important caveat here, this is our mid-cap portfolio. And the reason I need to call that out is because we haven't been able to conduct this survey right here for our small cap portfolio. There is, because we graduate small cap stocks into mid-caps and occasionally demote, or whatever you want to call it, a mid-cap stock into smalls, there is substantial product overlap, but this has been a very labor-intensive chart to create. So this chart here is actually based on our mid-cap portfolio. Just want to put that out there. I would expect to see something very similar when we complete the small cap study, but I did want to show you guys this. So what you see is that black line, that's what we expect. Over time, we expect our companies to just grind out revenue growth and grind out profitability and earnings growth. And that's historically what we have seen. Now the variability comes from what we call convergence, which is the valuation convergence of the company. So what are you paying for those revenues? What are you paying for those profits? And in some years, in December of 2020, when the valuation cycle was very high, we did not expect much of a return from an improvement in the valuation of our companies. Basically all of our expected return came from intrinsic value growth. Now we're in a situation where actually better than half of our expected return comes because some of our companies have just gotten so cheap. So this gives you a sense, and again, I would expect very similar results from our small cap portfolio, again, because the companies involved are oftentimes the same. And once we have that available, I'll send it along as well. I'll probably bring it down next year. And then finally, you see a little bit of in gray there, that's the dividend. So when you say forward 7 years, where is our expected return coming from? Those are the sources of expected return.
And to bolster that case, we developed a steady fundamental progress of portfolio companies. I mentioned that we had seen that fundamental progress, that fundamental growth driving the portfolio really being the engine of value creation in our product over time. And as a caveat, again, this is still the mid-cap portfolio. But because this portfolio we use as our model portfolio is what we target client investments to, and then when we trade into or out of stocks in that portfolio, it's at the same price that our clients actually realize. So it's based upon hypothetical money, but it's right alongside our clients, and the returns realized in the portfolio are right alongside our clients. The reason we use the model portfolio is because there's no cash flows into or out of the portfolio. And so what happens is each share owned by that portfolio owns a certain portion of the revenues of the underlying companies and owns a certain portion of the underlying profits. So if we just count up all the shares in the portfolio, we can actually aggregate up all the revenues the portfolio owns and all the profits the portfolio owns and say, your portfolio, if you think about it as a conglomerate, a group of companies that owns an underlying revenue stream and owns an underlying profit stream, this is the stream that it owns. And so if you look, the growth in the portfolio of revenues and the growth in the portfolio profits is strictly based on investment decisions. It's not based on cash flows coming in. So when we say our mid-cap portfolio went from owning $17 or $18 million worth of revenues in December of 2006 to now owning nearly $120 million of revenues today, that's because the underlying companies have grown and because we have roughly a 7 to 10 year holding period for our portfolio holdings. That's usually the same companies having grown their revenues over that period of time. And so we think that there's good, strong fundamental growth that continues to be realized over time. If you flip to the next page, the 7-year annualized profitability growth over that time was 17.3%. In terms of EBITDA, you see that in the box in the upper right. And you flip forward, and the 7-year annualized return or intrinsic value growth was about 17.3%. So what we see in the intrinsic value, again, of our mid-cap stocks, which has substantial overlap, is that we see that the growth in what we call intrinsic value of the companies has actually been supported by growth in their profits and growth in their revenues over time, because our portfolios are stable, that is growth in actual underlying companies that we're experiencing. And so it gives us a high degree of confidence in our ability to say, yes, we do a decent job at forecasting the growth of companies, and we hold them long enough to realize that fundamental value creation. Now what you see on the orange line is the market value discount to intrinsic value. So this is what the market thinks they're worth relative to what we think they're worth. So the black line is what we think the overall portfolio is worth, which right now is $120 million approximately in revenues, and we thought it was worth about $300 million based on the profitability profile and the growth profile. The market right now is trading that at a 45% discount. If you go back to 2008, it was more substantial, it was a 63% discount. But over time, by December of 2014, and then you see it again in December of 2019, the market trued up to almost our intrinsic value estimate. And usually when that starts to happen, because we experience probably 9 to 10% fundamental growth oftentimes for periods, we try to rotate capital into higher return names. So we try and keep our intrinsic value in the portfolio below what the market thinks it's actually worth right now. So those periods where it gets to be a very, very low discount, like 2020, which was the lowest we've seen in this record, 3%, we do tend to try and spend a lot of time raising that expected return profile, which you see that was paying off initially. We spent a lot of time on it in 2021. On top of that, now the market has dropped. And so that's what gives us this wide valuation discount. So the results of that, if you flip forward 2 more slides to page 28, this is kind of a very, very simplistic slicing, but it's representative of what we see coming out of these cycles. What you'll see from us over time is that if we can hold serve, if we can basically try and stay in line with the market during a market downturn, that's pretty good for us, because oftentimes the valuation super cycle that drives a crash will oftentimes be something we decline to participate in, and so we will have underperformed. During that peak period, we'll try and stay in line as the market declines, but then on the far side of that, because we are very, very disciplined with our portfolio, we buy good companies that stay in business and generate profits, and we just let them grow and pay a reasonable price for them. It's the far side where a lot of people have panicked, where a lot of portfolio distortions occur, but we see very, very strong absolute and relative performance. So when we say the next 5 to 7 years we're fully invested, this is our sweet spot. This is the time where we see really, really potent returns from what we do specifically for clients. And so these stretches going forward here are generally where we earn the best returns and really build that long-term performance record that you guys have seen for the last 28 years from us. And so the fact that during this cycle, we actually stayed in line with the market is pretty, I would have expected if you go and look at past cycles like this, the 2000 timeframe, you look at the 2006 and 7 timeframe, in a more subdued fashion, a little bit in the mid-teens here. But what you'll see is us underperformed relative on a 1 or 3 year basis for a little bit of a stretch because there's a big chunk of the market where valuations are rising too much and we decline to participate in that. We say it's too expensive, we're not chasing performance. And on the far side of that, you see very, very strong performance coming out of it. We've already seen a little bit of it this year. We're not through the economic noise yet. I wouldn't expect that to manifest fully in the space of just a few months or even, a full year. But we think over the next 5 to 7, we're going to see some really, really powerful performance. And the last piece, I'll stay on this slide, in slide 29, just because I don't have a slide for it because we still haven't figured out how to put this in a slide, but is innovation. And we think that this is probably one of the most fundamental drivers of our portfolio. And we're right towards the end of the presentation here, so I'll spend just a little bit of time on it because this is where I get to talk about specific investments. But if you look across our portfolio, when people say innovation, a lot of times, because of the financial press, you'll hear people talk about, Kathy Woods with ARC. They'll talk about Tesla. They'll talk about a lot of these stocks that are, I don't want to call them hype stocks because I don't want to speak ill of anyone else, but they had extreme valuations attached to them and extreme expectations attached to them. I mean, Tesla's going to change the world. Every car in the world is going to somehow mine the billions of tons of lithium we need for it and become electric over the next 10 years. You'll see industrial scale battery storage, meaning that we won't need coal or natural gas plants. You'll see all these things happen. I don't totally understand how you get the resource configuration to make that happen yet, or even make it make economic sense, but there's a lot of innovation in the economy, and that's what people oftentimes think of when they say the word innovation. When we say innovation, we're talking about the fact that Silicon Valley is not the only user of software. What we've seen is in a lot of companies, a lot of different spaces, they aren't the first adopters of some of the latest and greatest software solutions, but when it comes, it oftentimes drives more economic value at spots like grocery store chains, at spots like airlines, at spots like industrial manufacturing floors and logistical plants. All those spots are where the economic activity in the economy actually happens. You have the tools suppliers, which is the software companies, but they supply to the people who are actually making the economy go. And the value that they create with innovation is extremely potent. So I look at a firm, one of our investments in the small cap portfolio is a company called Pros Holdings. And what Pros does is their first customer back in 1982 was actually Southwest. And initially what they did is they're the ones who make sure that you're gouged on your airline tickets, because they can microsegment all the way down to the individual customer, gauge the willingness of that customer to pay a certain price for their airline ticket to wherever it is, whenever it is, and create that dynamic pricing where the airline tickets are always changing.
Right.
What that helped do was raise the load factor in the airlines industry from roughly 60% to over 80%. And if you think about the amount of money people spend to buy a jet, the biggest thing you have to do to make sure that makes economic sense is fill that jet. And so saying I can drive a third more customers just with the software platform onto my jet, and now, by the way, I can sell them a cup of Starbucks and an Uber ride on the way to the airport, oftentimes which have a bigger margin attached to the plane ticket. I can make sure that I sell them a package or a solution, I can cross-market to them, and I can gauge better willingness to pay based on whether this is a corporate customer and everyone else. And I know those things even if they haven't told me, because I've plugged some of the most sophisticated artificial intelligence, which is a buzzword, but Pros has been using it for years and years and years, to do these things. And now once I've mastered that industry, I can take it and I can sell it to hotels and cruise lines. And now that I've knitted those up, I can now sell it into the chemicals industry. Because when you're writing a large chemicals if you're Dow Jones, you have to sell potentially 10,000 SKUs into one of your end customers. And how to make sure that you're making profits in all those SKUs and that you're actually earning the best profits on the ones they need the most by gauging their willingness to pay over time. And then putting the bumpers on the sales guy to ensure that he's happy selling within this paradigm with this guidance, and doing all of those things and embedding it in the core process, and then extending that down to your value chain and purchasing on the underside of that, saying, well, this is what we're selling them for, this is what we're seeing in our willingness to pay up here, here's the forecast that we're looking at. I can now push this down my supply chain and say, here's our willingness to pay, and we're going to negotiate with you because we understand the structure of that industry. You can see just by installing Pros software, in many of these industries, they're seeing a be 2 or 3% revenue uplift just from optimizing their pricing and contracts. Now, that might not sound like a lot, but if you're operating at a 5 or 10% operating margin, and for a fairly small relative fee, you raise that with no overhead besides paying the software subscription costs. Plus, you get the price governance and visibility into how you're selling and what your sales guys are doing out there. You can oftentimes raise your profitability by a few points, which, you know, might be a 30% profit uplift. So it's a very, very big deal. And I chuckled because when C3 came out, they said we are the largest supplier of AI out in the industry and that sort of thing. And I said, you have half the revenues of pros, which we've owned for years. What are you talking about? And I actually tweaked the CEO. I said, you have terrible PR. No one knows about you. But these are the sorts of companies we're investing in. You see the oil and gas industry. I believe you guys have an investment now in a natural gas provider, Southwestern, in your small cap, another one that was demoted. Southwestern was the second largest natural gas producer in the US, and it became a small cap stock. It was ridiculous. So now we have investments in that because I don't know how you get enough lithium to talk about the conversions that people are pushing out to the future, and battery technology hasn't gotten to a place where it makes any level of sense to push it out that far into the economy. I mean, you're already starting to see the limits of it. In fact, if you guys want additional reading, I won't waste too much of your time on it, but on pages 34 through 36 here, you can see what happened to Germany's energy costs as they've installed more and more renewables. We call it non-dispatchable energy. That's energy you can't turn on and off when you want. It turns on and off when the wind or the sun are working for you. And then dispatchable
is following that model.
Yeah. We wind up with a situation where dispatchable energy, you know, the coal plants, the natural gas plants, the nuclear plants, and to a degree hydroelectric, that's a little bit of a gray area because usually the rivers are flowing pretty consistently. But the dispatchable energy in Germany has actually gone down. The non-dispatchable has gone up. On page 35, you see what's called their total capacity factor, which is what percentage, if you maxed out the generative capacity of everything you have installed, and then you take what you're actually generating out of it, that's your capacity factor. So they're using 28% of their potential now. That's dropped from 54% as non-dispatchable has come online, because if you are running your solar 20% of the time and your wind 40% of the time, those are actually really good numbers. Usually it's below that. If you look at natural gas and the others, now you're using that as supplementary capacity, because when the wind stops blowing, then you have to turn on your natural gas. But if the wind is blowing, you turn it off, so it actually sabotages your capacity factor for your dispatch or your non-dispatchable energy. And so what's happened is they have more and more money plowed into generative capacity. It's actually a pretty huge amount to spend because it drives the power generation capacity in their entire economy. They have a lot of energy-intensive manufacturing. This is a big deal for Germany. And on page 36, you see the results, which is the second highest energy costs in the entire world. This is not every country in the world on this chart. You can see the US is on there. You can see a number of others. It's a representative sample, but I can tell you at the top there, Germany and Denmark, those are the top two costs of electricity in the world. When you have an export-oriented manufacturing sector driving the heart of your economy like Germany does, that's not necessarily a good thing. It makes them less competitive in their core sources of employment and economic value creation. So I oftentimes joke it's a kind of a scary setup because you have Germany looking at an economic downturn while they're busy rearming. We know how that's ended, not to speculate too much. But overall, we think, going back to the last point I do want to leave you with, we do see that innovation in many of our companies, and they're in called the unsexy parts of the economy. That innovation is actually driving real value creation. It's making companies more efficient, it's making them more profitable, it's making them more sustainable, and it's making them longer term. And so for us, it's been a revolution in our portfolio, and more, the orientation of our investments. Not only are we investing in a lot of places that you wouldn't associate necessarily with innovation, but we're seeing a very, very powerful impact of innovation. So if you say the first wave of kind of software innovation, the cloud, artificial intelligence, and all of that, it's easy to look at and point to and come up with more key cases if it's based out of San Francisco. We're seeing that now percolate onto the economy, which we think is going to be ultimately the more potent source of value creation in the economy, and that's what we're invested in. Consequently, because these business models is assembled from the bottom up, we just, not only do we see that high expected return in the portfolio, but
it's one of the highest we've ever seen in the portfolio. It's also one of the highest degrees of confidence we've ever had in that forward return in the portfolio. So the fact that we have a great track record in our performance numbers right now, and then we're set up like this, is probably, I mean, it's not something I have seen in my career. Even coming out of 2008, we knew we were going to generate healthy forward returns, but we didn't necessarily have this degree of confidence in the portfolio. That's not necessarily saying we had bad investments then. It's just, you know, because of the economic turn of events and because we had a number of stocks where, you know, they were high expected returns, but there was more uncertainty associated with them. Now we feel very, very good about the forward prospects. So since that's the primary point I wanted to come down here and make to you guys, I'm going to leave you with that. I'll stop there. There's other stuff in here if you'd like, but I can answer any questions from there. And then I have one more item once we finish that.
Just a comment or a question, I guess. The bottom 6 or 8, well, the highest cost per kilowatt hour, about the top 6 or 8 costs, tend to be in Northern European or countries that don't have a lot of solar capacity.
Correct. Germany is not optimized for it. They're okay for wind, they're not great for solar.
I just want to make sure I understood that.
Yes.
My anecdotal.
There's actually, if you're interested to dig into it, there's a couple of resources online. I can't remember the name of the websites, but I can send them on if you like. But they show a heat map of the entire world in terms of how optimal each geography is for wind or solar. When I reference those 10 and 40% numbers, I'm actually using West Texas because they have almost the optimal mix for both. I mean, they're great for, it's sunny and it's windy there all the time.
Yeah.
They have a lot of installed capacity, so you can actually look at how it's performed. They've run studies on this same, and there's a seasonality to it, which is a little bit complementary between the two. You know, when the wind settles down a little bit, oftentimes that's during the sunniest seasons, late in the summer, and then vice versa. In the winter, the wind seems to pick up there, so there is, in West Texas at least, this complementarity. So they've done a lot of studies on it, and that's what allows me to talk about factor utilization.
Thank you.
Pending no other questions, and we can always jump back in. The other thing I brought down here today, it's in your stack. Thank you, William, for printing everything out. We had this down a little bit later because we were just getting all the sign-offs on our end. This is, over the years, we occasionally have exception requests based on our manager instructions and our IPS that we have with you guys. Generally, it's because of a position size exceeding the upper threshold that's established right now. So what we've been doing with a lot of our clients now is standardizing on this because a lot of new prospects at least want some language around both a single position limitation and a sector limitation overall. And so we spent a lot of time the last few months going and doing some analysis on historically what has been our maximum position sizes, because you guys have always been easy to work with on this. You've granted us an exception if one of our positions has breached the ceiling in the IPS, so it hasn't been an issue except from an administrative overhead standpoint. We track this in the rules manager system we have. But we wanted to modify it so essentially we're not tripping anything, we're not changing our investment style or anything else like this. This is just cleaning it up and making sure that we have standardized and we have clean language that you guys are okay with. So the amendments or the changes we request are in 2 for each, one for the manager instructions and 1 for the IPS. The manager instructions, we're looking for a maximum position size from 10% to 12%. Again, we've never had a concentration that high, so we've gone back and looked, and this would be something we just don't trip with our investment style in almost all cases. And then a sector weighting, what we did here is we said because we want to look at the underlying economy, not necessarily what the index fund, because if we had a sector weighting based on S&P 500, it would have said, well, you can invest a third of your portfolio in what we think are some of the 8 biggest and slightly overvalued companies in the world, which we don't think is a great way to run a ceiling on our investment style. We want to look at underlying economic activity, we want to look at a full cycle, et cetera. So what we've come up with, and we've talked to several consultants and prospects about this now as well, and so we're putting it in front of you also, is a 66% of the portfolio based on 3 super sectors, and these are common definitions of super sectors, but we have the information economy, the consumer economy, and the manufacturing economy. And so what we'd say is, at no point would the portfolio exceed the weight of 66% in any of those 3. Information economy is within, I believe this is a Russell categorization schema here, information technology and telecommunications, so that's
be like an Apple, or it would be like a Pros that I was just talking about, et cetera. You've got the consumer economy, which you're talking about consumer discretionary, the financial services, real estate, and healthcare. And finally, manufacturing economy, which is the energy. This is another one that's interesting because for certain indices, and especially with ESG, energy dropped to low single-digit percentages of the index, whereas we were invested to the tune of 10% or better in some of our product. And so that would have been a 5x the ceiling imposed by sector weightings, even though we think there's a ton of potential in the natural gas sector, which is where we are investing in. 10% is not the entire portfolio. And so that materials, utilities, consumer staples, industrials, that gives us the flexibility to make sure that we do have diversified economic exposure within the portfolio, but it isn't tying our hands based on whatever the vagaries and popular sectors of the index are at the time, because you do see it where energy drops to 2% and information technology rises to 50% and things like that. We don't think those are necessarily, and that's single sectors, that's not even a super sector. We do have supporting charts that show what these have done over time in terms of the actual economy and the indices. They are very stable. Our exposures to them has been very stable. And again, nothing here changes with our investment style. This is just something we want so that we are all on the same page with all our clients on what exactly it is we're doing. Down at the bottom within the IPS, right now you've got the exposure to individual issue of 7%. So that's a cap we have reached numerous times. And again, you guys are very good about granting us exceptions on that because we don't buy more than 4% of a position at cost ever. And it's actually fairly rare that we even invest 4% of the portfolio into a single name. And that is not all at once. That's usually spaced out over a number of years. And then, of course, the super sector piece as well for the IPS. This is something that, as I understand it, rises to the board level here. So I wanted to make sure that we came down here and explained this thoroughly and see if you guys have any questions on it. But these are our requested changes to the investment manager instructions and the statement of investment policy.
Are these for, this says general plan on top, does that mean for us also, or?
We may have sent you the wrong one. There were two letters.
I've got mine's police and fire here.
Yeah, they're requesting the changes for both items.
I think I know, Eugene, I think I know where, I mean, I yeah, it says police and fire at the top, and then it refers to general within the body, but I don't.
Oh, is the general, where do you see general in there?
Dear William, we have reviewed the current investment manager instructions for the general plan and
Yeah,
identified.
we'll have to strike that.
Okay, we'll get that fixed.
Yeah.
Oh, I see.
Yeah, so this is going off of our, we haven't changed our investment policy since 2013, is that correct?
That's the last signed version we have from you
I
guys.
think we have, and maybe we just didn't forward it out to all the managers, but, you know.
I don't think we have since I've been on, and I think I've been here since 8th.
Cole, correct, I thought 17 maybe, or maybe even more recent than that.
Yeah, I think I'm trying to check right now, but it's been in the past few years.
If the changes were minor, they were maybe just like asset allocation target changes for the most part. We try to revisit that, you know, and look at that on an ongoing basis and maybe update it every 2 to 3 years. So I'm pretty sure we do. We can bring, you know, an updated investment policy statement to the next meeting. But, you know, I've discussed these requests with Willis Towers Watson, and, you know, I think we're okay with them. Cole, you know, I'm not sure that when we discussed it, we saw this exact level of detail. So, you know, whatever your feedback is, we'd welcome that.
Yeah, I think some of this is a little bit new. Overall, just increasing security exposure to 12%, I don't think there's a big issue with that. I think our concern, William, was in the second piece of just the portfolio weighting to the sectors. So this is classifying information, consumer, and manufacturing, which we haven't seen before, but just wanting to be cognizant of not overweighting one sector too much. I believe the portfolio is about 46% information technology sector right now. Nick, is that?
That's going to be about correct. A large part of that is driven because we've had one position, super micro, is probably around 9% of the portfolio currently. And so the distortion in the sector exposure is in turn caused by a distortion in a single name that's it's gone up significantly while the rest of the portfolio has dipped in value. And that's a dynamic we saw back in 2001, actually the last time where we had any discussions generally around this specific issue.
The manager instructions, is that what Bob works at, like with the contracts?
Yeah,
Is that
so
basically-
we have separate manager instructions for each manager
Right.
that are sort of.
That's part of all the stuff he has to
Yeah.
draft up when we're,
All right.
and so should we, if we are considering these changes, or to write, language to allow it, do we need to vote on that?
Yeah, you would need to vote to, you could authorize me to sign it if you like, but the language states that, you know, in lieu of making changes to the investment policy statement and the manager instructions, that you just, you know, sign this letter in effect, and that would facilitate the new
Exception language?
Yeah.
That's what I was, okay.
And Cole, Nick Iceland, that our Director of Institutional Clients, he drafted this language and he's very well versed in it. So if you have specific questions, I can put you in touch with him. You may have spoken with him already as well.
Yeah, sure. Yeah, happy to chat with him as needed.
Sure. And for all your context, there's, I think we talked with William over the last year about figuring this out. So there's no particular level of urgency attached to it. There's been no change in what we're doing. We're just trying to get clean language that are acceptable to all parties. So if you guys need to table this and discuss further, I just wanted to put it in front of you, make sure that you can ask me any questions you have specifically on it as well.
We already have a meeting next month. Does anyone object to voting on it next month?
That's fine. I mean, I'm prepared to make a motion, but waiting for Cole's feedback is probably a good idea.
Okay, well, let's stay there.
And we can bring the investment policy statement next month as well for review and see if there are any other changes that we want to incorporate, so maybe we can update that at the same time.
And then do let me know if you need any further data from us to help with this. I mean, this is pretty parsimonious language in the letter. We have some other stuff you can look at if you're interested.
And nothing was pressing on PGI's end, right?
No, this is something we've talked about. We occasionally request an exception, usually on the position sizing piece.
This will be more asking for exceptions on breakout pieces.
Yes, yep. This is just to, again, clean up what we've always done.
All right. Let's
So
plan on-
Nick, real quick, while we've got you, with the technology sector being so high right now, you know, close to 50%, how do you think about that going forward? Just wanting to be cognizant of, obviously we don't want to, you know, have exposure to a sector fund per se. I know that's been a large return driver of yours, and it's really been a huge tailwind to portfolio, which has been beneficial. But how do you think about managing that kind of sector return driver risk going forward?
Sure. Well, one of the things I'd say is specifically with the information technology sector itself, it's a very heterogeneous sector in terms of business models and end market exposure. If you're talking energy, there's not as much heterogeneity, I'd say, as one of the more utilities. They're much more homogeneous sectors in that the returns are, you know, a big chunk of them are going to be driven by the underlying commodity prices. With information technology, what I mentioned is you've got, you know, a spectrum of companies like A Pros Holdings that I was talking about that sells into airlines and cruise ships and hotels, which just got completely bludgeoned during COVID. They did, despite being a technology company, the stock did not do well during that period. That was driven by their end market exposure. At the same time, you have other companies, you look at Zoom, which did the exact opposite and then has since pulled back again. And because it's in our minds, the categorization of information technology is not as driven by a cohesive assessment of the business model as it is with, say, a natural gas producer. And because of that heterogeneity, it's probably one of the sectors that we look at and say, if you wanted to look for a sector that long-term correlates in the long-term investment horizons that we invest in, correlates in its fundamental performance, information technology is probably one of the lowest rates of long-term internal fundamental correlation, which is how we invest. So when we manage our exposure, what we're looking for is very good business models that do have a diversification that stems from their end market exposure, that stems from their business models, that stems from the nature of the company and how they work, and not necessarily because they fell into a bucket that Russell, in its infinite wisdom, gave us. we do run a diversified portfolio. I mean, what you should expect from us is that you should see 40 to 50 names, and they will be driven in all sectors of economic exposure. We are not looking for a sector-based investment strategy, though. We don't talk about things like tracking error and a lot of the typical language that you will hear from other companies. What we've done over time is saying we are going to find very good business models and invest in them, and post facto at the bottom of that we'll drop a sector exposure weighting. And if you look at what that's created, that's historically been about similar weightings through time. There were points where, for example, in 2007, we eliminated almost all our exposure to the financial sector. We just said this whole sector, again, that would be one of those ones I'd point at that has a little bit more homogeneity in the business models because they're driven by interest rate spreads, setting aside financial services, and the spreads at that time and the valuations attached to them just didn't make sense, and that caused us to sell out of pretty much every piece of financial exposure we had. Past that, again, we're investing in companies that we see very stable long-term prospects, and so we don't spend a lot of bandwidth managing sector exposure. Consequently, when we have language around it, we worry that it becomes an impediment to our underlying process, which has produced the results you guys have seen.
Got it, thank you.
Yeah.
Any other questions? Thank you very much, Nick. We'll vote on it next month.
Great, I really appreciate you guys' time.
It's a great presentation.
Thank you. It's actually the first time I've had to give this one, so you guys were the guinea pigs. I appreciate your forbearance on that. I'm going to steal this version of the letter because I made some notations to make sure we clean up that general piece. Again, if you need any more resources from us, happy to follow up with you, Nick Iceland, Cole. I'll make sure that you two get in touch.
Okay, thank you.
And I'll step out and let you continue with your meeting.
Thanks, Nick.
Yep, thanks guys.
Appreciate it.
Good seeing you too. I appreciate it.
All right, next up on the agenda, presentation from Willis Towers Watson, Cole Jacobs, and Zach.
Yep, hey everyone. Pretty straightforward agenda for us today. We'll give an update on the capital markets through year 2022, and then look at performance. And then we have one slide on the DGI sector weights. So happy to discuss that additionally as well if needed. So starting here on slide 4, we have finally concluded the year of 2022, which was, as we all know, an extremely volatile and negative year for capital markets across the board. So the yellow bars here on the top of the page, equity on the left-hand side, fixed income on the right-hand side, both largely negative for the year. This is the third year that both equity and fixed income markets were both negative. The last one being 1969. So somewhat of a rare occurrence that we saw the type of capital market environment that we did. Related to equity markets, S&P 500 finished the year down 18%. The fourth quarter was actually very positive, up 7.6% for the quarter. But despite that, the overall return for the year was down 18%. You can see pretty similar returns across the board for small caps and international as well. Related to the fixed income markets, the high yield markets were down about 11%, some of the longer dated maturities down close to 30%. And that's because, as we know, yields increased significantly throughout the year, and you can see that on the bottom right-hand side. So the blue bar was 1 year ago, and the purple bar was as of December 31st, just a few months ago. The Federal Reserve obviously raised rates significantly. The front end of the curve moved up almost 4.5% throughout the year. So somewhat of an unprecedented monetary policy response from the Fed. They have since raised rates another 25 basis points this year. That was in January, and then they're meeting again in March. And it's anticipated that they will raise another 25 basis points then. Obviously keeping a very close eye on the inflation numbers and what's been happening there. You can see in the bottom left-hand chart, headline inflation is 6.5%. The most recent print through January was actually 5.9%. So while still elevated compared to the Fed's target of 2 to 3%, we are starting to see that ever so slightly moderate. And that's given the market hope so far in 2023, and we've seen a pretty good response. Markets were up this year through, a month and a half, up almost 8%. It's about 6% now. The last couple of weeks have been somewhat negative, but overall off to a really good start as we've seen these inflation numbers start to moderate. The market anticipates the Federal Reserve could possibly engineer a soft landing, not tip the economy into recession. So that's been somewhat well received so far this year, and it's been positive for markets. Any questions on the year of 2022? I know we have chatted about it a pretty good bit, but finally come to conclusion. Okay, so how does that relate to pension plan performance, which we can see on this slide here? So for the year of 2022, the plan returned minus 13.2%, which was slightly below the benchmark of 12.6%. But overall, in line with the policy benchmark, and in a year where equity markets were down close to 20%, longer dated fixed income markets down 30%, and high yield down 11 or 12, a return of minus 13 from an absolute perspective is pretty good. The portfolio did benefit from the alternative credit, or the income segment, I should say. So we'll look at those returns in a little bit. The growth segment, you can see here, returned about minus 18%. So fairly in line with markets. We had some strong performance from some managers and weaker performance from the international manager. So kind of going down the line, looking at LSV, they returned minus 6.7% for the year, compared to their benchmark of minus 7.5%. So added a little bit of alpha there. And from an absolute perspective, performed really well, being down only 6.5% in a down 20 market. Pretty good, as value did outperform growth substantially over the last year. Sustainable growth advisors, they've matched their benchmark return for the year, minus 29 versus minus 29. So certainly you can see the disparity between growth and value in those two managers, one being down 7, one being down 29%. So certainly take note of that, but however, matching their benchmark and doing a good job. SGA did have a good quarter, returned 6.3% versus 2.2%, so a really strong quarter from both them and LSV, really, and a good year with the large cap segment overall. The small cap segment also had a good year. At the segment level, returned minus 16% versus minus 20%, so added 4% value there. LSV really added a lot of value here. They were down 5.5%, and their benchmark was down 14.5%. So value just absolutely performing really, really well, and LSV participating in that. They had a really good quarter, up 14 versus the benchmark of up 8. So LSV, for both large and small cap, doing really well. And then DGI, we just heard from Nick, really good performance, especially over the long term. Their 1 year number kind of matched the benchmark, both down about 26%. But look at the 3 year number there, up 6.9%, and the benchmark is pretty much flat. So really strong performance over the 3 years, and it's kind of crazy that you've had them since 97. So you've certainly benefited from extremely long-term compounding from them as well. And then just rounding out the equity piece here, Mower International had a little bit of a softer performance for the year. You can see down 20% and the benchmark was down 16. So they faced some stylistic headwinds. They tend to be a little bit growthier than their benchmark. In a year that growth didn't perform as well, that was a headwind for them. For the quarter, they kind of matched the benchmark, and long term, they're ahead of the benchmark, but for the year, just a little bit underneath. So then, moving on to the next page and looking at the income segment for the year, the segment here returned 2.4%. So, the plan benefited from having more income-generating assets as opposed to growth-oriented assets in a year that was extremely volatile. So, good to have that positive absolute performance. A lot of that came from real estate. But the alternative credit segment did hold up pretty well. It was down 2.8% for the year. So, in a market that's down 11 or 12%, being down 3% added some value. The two high yield funds kind of stick out, Aries and then the Fallen Angels, minus 11.6, minus 13.3. In line with the benchmark return of minus 11%. And to be expected as rates moved up so much. The other two strategies here, One Sharp and LibreMax, posted positive returns for the year. One Sharp continuing to kind of plug along at their 6% per year return. So really strong performance from them. And that is the most heavily weighted fund here at 6.6% of the income segment. And then LibreMax, essentially flat performance, but in a market that's down, pretty good performance overall from them. And then with the real estate segment, we have our first month of performance from the Harrison Street Social Infrastructure Fund, which you can see at the very bottom. It got off to a really good start. It is up 2.4% versus the benchmark down 5.1%. That was for the fourth quarter. The since inception return is positive 4.3% versus the benchmark of minus 4.3%. So adding 8.5% of alpha since July of last year. So off to a really good start there. The Harrison Street Core Property Fund in the middle, they had been struggling a little bit throughout the year, but really kind of turned it around here in the fourth quarter. They returned essentially flat for the quarter when the market was down 5, and so for the year they were up 11.5 versus 7.6. So really strong quarter, kind of moved their one-year number up well above the benchmark. And then Principal performing well, essentially matched performance for the quarter, pretty close to the benchmark over the one-year period, 5.1% return for the year. Longer term performance is in really good shape. And overall, the real estate segment returned, over 10% for the year. So the portfolio certainly benefited from, the positive performance, both against the benchmark and just in general in a market that was, pretty significantly negative.
Cole, what are the real estate segment? Do we feel the benchmarks are good benchmarks or best available?
Yeah, it's hard. So the NCREIF ODCE is essentially aggregating all of the large real estate managers' returns in the market. So it's tough to get a perfect benchmark in this area just because it's not publicly traded. There's some data aggregation issues, and so that's what the NCREIF ODCE is. It's aggregating, I think, the 32 largest managers in the space, Principal being one of them. So to answer your question directly, it's not perfect, but it's pretty good. And it's kind of the definitely the standard in the marketplace to use that. And that's why all three of these managers, you can see, use the same one.
It's probably less perfect for the more specialized real estate like the Harrison Street social infrastructure, but it's what we have, you know, it's got you so.
Okay, thank you.
Yep. Any other questions on performance? Overall, it was a volatile year, but, you know, being down 13% in a year like 2022, all things considered, was pretty good. So, last thing here, just the DGI amendment request. So what is shown here is a little bit different than what Nick just reviewed. Happy to answer any questions here. I think, you know, from the first issue of just concentration of individual securities, overall we don't have an issue increasing that. We had it to 10%, they had it to 12%. Either way, not a large issue. Overall, we do like to allow managers more flexibility. It gives them the ability to kind of move around the market where they see fit. You know, removing guardrails, etc., kind of allowing them to just let their best ideas work. That being said, you don't want them to be 100% one stock at its most extreme, right? Or just extremely concentrated, because it can lead to some pretty high tracking error, which you all stomach pretty well. That being said, the second piece on just the sector weightings here, you know, ultimately it's up to you all. However, you know, you can see there the purple bar on the graph on the right. Their technology sector is, you know, 46% compared to the index of 20%. So if you look at attribution for DGI, it's going to come down to that. If tech is doing well, they're going to do well. If tech is not doing well, their relative performance will struggle. So it's just something to be mindful of. You know, what kind of limits do you want to place on that, if any? Because you don't want essentially to have a sector fund here where it's, you know, 60% of the portfolio is all coming from one sector.
And Cole, just to, go ahead.
I had a question for Cole. It may just be how originally it referred to 5 industry groups, and now they've switched to the term economies. Is that just a change in what the industry standard is, or is that really a shrinking of their pond?
So I think that's unique to DGI. Zach, correct me if you've ever seen that before. I haven't seen it broken down in those 3 buckets before. Now it makes sense to an extent, you know, information economy, consumer economy, and manufacturing economy. But there's all kinds of different ways that you could break it out. You could break it out into 5 different buckets, or 3 different buckets, or 2 different buckets, and I think it could be a way for them to increase their tech exposure a little bit more, because I believe they've lumped technology and telecommunications into that one sector and put a 66% limit on it. So I think it's unique to DGI that they're looking at it that way. It's not wrong, but it's a way for them to kind of get a little bit more exposure to the tech sector, I think.
And just to give the board some background, I was discussing this with the consultant for the general pension plan, ANCO, and I think this new letter that we only received yesterday with the details, which is why it's different than what Willis Towers Watson has on page 7. It came out of discussions that I had with ANCO and that ANCO had with DGI, and you know, I agree. My main concern was that you didn't want to end up owning a tech sector fund. You know, having a 66% or whatever it was limit on tech combined with telecom, which they don't own anything in it right now anyway, is a way for them to increase that. But my understanding originally in the discussions was they're concerned about increasing, they initially wanted to increase market value limits on sectors to 2 times that of the underlying index. And in discussions, it had more to do with energy and some other smaller weighted sectors than with Infotech, according to DGI. They like some of these natural gas companies, and so they wanted to be able to increase their allocations to the energy sector, which I guess evolved into this super sector grouping that they developed. But, I mean, I think it's worth maybe, Cole, you guys having a discussion with them if you like at some point with their client service officer or whatever. And then letting us know maybe before the next meeting or at the next meeting, and maybe you and I can talk about it.
Sure.
Whether we have real concerns or whether we think this is okay.
Yeah, absolutely, happy to. But I think you summed it up well, William. It's just being mindful of buying a sector fund here. If that increases any further, it's definitely going to be a very dominant return driver. And Nick answered my question about, what does that look like going forward, and just the diversity of that sector. It's not, we lump it all into one bucket called technology, but to his point, that means a lot of different things and a lot of different kind of subsectors, which is fair, but at the same time, it's still a pretty dominant return driver. So, yeah, we'll touch base with them and review it at the next meeting.
All right.
Happy to answer any other questions if there are any.
How long have we owned that New Harrison Street? A month or two, or what?
6 months.
Is it 6 months?
About 5 or 6.
Okay.
Yeah, since July. And then, as a reminder, you are in the queue for the new Bean Industrials Fund.
Okay.
And they are expecting to call some of that capital, I believe, here in a few weeks, so for the first quarter. So more to come on that. I think they plan to have that ironed out in middle of March.
We'll be meeting then, right? All right. Well, thank you very much, Cole. Appreciate it. Is there anything
Yeah,
else?
thank you all. Have a great rest of your day.
Bye, Zach. Nice talking to you, Zach.
All right. Next on the agenda.
Yeah, right. That was long presentation by DGI.
Yeah, you like to go into detail.
I enjoyed it.
To be fair, we didn't give them and you have 25 minutes to do it. You
No.
have 20 minutes.
We're gonna request a shorter
yeah.
presentation tomorrow.
Yeah, wait till
I
tomorrow.
thought everyone seemed to always enjoy his presentation.
Yeah.
That's why
He's
everyone
very
just sits
good.
back and
He's
listens.
a good presenter.
Yeah,
It's
but
relevant.
when you give people no parameters,
I don't know.
they get out of the focus of what's really important that they want to communicate, and they communicate the
We didn't
universe.
need a 15-minute
I-
discussion of ESG.
Yes.
Well, that was
My bad.
probably my fault.
So no, I'm just saying that
You got started.
it wasn't being critical.
We'll use a bigger question.
No, I
It
know.
was an interesting
So,
discussion.
I was just saying, man, you got to put some.
I know, last time I was here, I think I didn't remember his name and it wasn't written
Same
down.
goes.
I
Same
had to ask
goes
his
with-
name and everybody
he's
looked at
done
me
this.
like I was,
To be fair, same
Crazy.
goes with Bob.
Yeah.
You let Bob go, he can go forever.
And this was the first time I think he's done the presentation without Fred on his own.
No, it was very
Well,
interesting.
this, yeah, Nick.
It was just,
Yeah.
it's hard to believe.
you got something for us? Next on the agenda, Police and Fire Prevention Plan Investment Consulting RFP.
So the board had expressed interest in, at the last meeting in November, to, look at possibly doing an RFP type process to see what other consultants were out there and what services they offered at what prices. And so I think Steve had requested that I give the board a breakdown of the different processes available. So there's a handout in here called RFIs versus RFQs versus RFPs. And it kind of explains the differences between these processes. My opinion is that if you're serious about getting proposals, you need to do an RFP. That's really the only way to go, because a lot of companies may not respond to, I don't think he did as good a response to the RFIs and RFQs. An RFP, we can write it in such a way, and I provided an example of one that we did in 2019 for the general employees pension plan. We can, specify the scope of services that we want, what we're looking at, and, really get more detail in a response, and then also the price proposal would be included in that. So that would be my recommendation, is if you want to move forward, that you do an RFP. There are ways to do that. We can certainly draft up something along the lines of the example I provided, if the board likes, and you can, we can bring it to the next meeting, you can make changes to it, or whatever you like.
Oh, is this the RFP in the back here? This one?
Yeah.
Oh, here we go.
And this is for Willis Towers Block 2.
Right.
And it's for the,
It would be for Willis Towers.
right, consultant. And would the RFP only be reaching out to see who is interested in the delegated, or?
Well,
A little
we
bit
could
both.
write it both ways.
Yeah, your scope could be, could include delegated or non. Here's maybe it's just my long-term struggle with government in general, the RFP process, right? You get information on the proposal, but you get pricing. And you can't have that discussion on pricing, right, as part of it. So my preference is the ITN, invitation to negotiate, where you still can lay out all those parameters, but their proposal or pricing is the starting point. It doesn't have to be the ending point.
Well, I think this board can do whatever it wants. Like, there aren't limitations on what you can discuss in the RFP process, because this board doesn't have to follow city purchasing policy. So, the board,
Because that's what prevents.
I mean, it doesn't matter what
pricing
you
is
call
the-
it.
So as long, let's say we really like what they bring to the table, but are they worth a 20% premium on somebody else? They may not be, but they may be willing to change their pricing model to make it a little more attractive to us and people who
Maybe I
represent.
said it,
Is
I've
that-
watched them for 2 years.
Hmm? So that's, I just want that type of ability to have some leverage.
well, I mean, I think that regardless of what we call it, whether we call it an RFP or an ITN, we can write it however we
Okay.
want, and we can ask them to negotiate on their pricing if we like what they have to offer.
Let me
I
ask
will
the
say,
question, is your pricing negotiable?
Right.
Along that line, so I like them to throw out their lowest and best pricing model, but that's not the way it always works. I mean, I can assure you that's not how it works in the property and casualty insurance market.
sure.
That's a critical thing.
You start high and end up less high.
And I would say that on the general pension RFP that we did a few years ago, we got about 5 or 6 responses. There's been a lot of consolidation in the investment consulting industry. And what you tend to see is, you see the much larger companies that are more expensive as one segment, and then you'll see more regional type companies that are, smaller and lower priced as the other side of that segment. I would say that even though ANCO has grown, I would consider them more of a, even though they're national, I would consider them a smaller, lower fee type provider. They're the consultant we use on the general pension plan side. Willis Towers Watson, Mercer, Callan, Aon. These are these large conglomerate companies that don't only offer investment consulting for pension plans, they offer benefit consulting for entire organizations and all these other things that they do. But anyway, having said all that, calling something an RFP, I think, gets you more responses. And you can create it however you want. And if you want to create a subcommittee to look at it, or if you want us to draft something and bring it back to the board for consideration and editing, however the board wants to do it, we'll work with you to provide what you want.
Generally, would we just get their responses, or would they want presentation?
What they would do is they would send a response that would include all the
parameters,
information we
right.
requested. And then depending on how you wanted to do it, you could see everybody, you could have them all come in for a presentation.
Or you can narrow it down.
You can narrow it down to a short list.
Maybe ask for a couple other
Yep.
discussion.
You get 15 responses, narrow it down to 3 or 5, whatever it's comfortable with.
I like that.
But my thought is it's very, very labor intensive. Of course, it's labor intensive for the presenter, proposal, but it's also intensive for staff. And unless we, well, not unless, if we pursue this, we probably should have a benchmark, again, using, I would presume, Willis Towers Watson and their experience, their performance, and I'm not quite sure how you guys want to measure their performance, but use them as a baseline in comparison to other firms. Cost is only one, obviously. But,
And I've notified Willis Towers Watson that the board may consider doing this, and they would, of course, be welcome to put forth a response.
Yeah, exactly. But I'm just thinking from, well, is it worth the effort? Is there a problem that we created that we want to solve, or is there a problem that actually exists that we need to solve?
So the general consensus has just been, do we know what the market is? I guess we do. What is the general plan? You know,
So
it's a larger plan though, right?
the general pension pays a third of what this pension paid. They pay $140,000 a year to ANCO for consulting services. Now, it's not a delegated arrangement.
Right.
But, you know, we're paying close to $400,000 a year now to,
That's what the 10%
Yeah.
increase.
yeah,
And, you know, about half the asset size, right?
right. And if I have an issue, and I'm not saying I have an issue with Willis Towers Watson, I think they do a good job on the reporting and the due diligence. Their focus on the income segment, we've had more turnover in 3 years in their income segment than we had on the general pension plan in 20 years of investment managers.
Not the real estate part of the income segment.
The all credit.
All credit.
Yeah. And, you know, having said that, the police department pension plan did outperform the general pension plan over the past year by like 300 or 400 or 500 basis points, depending on which time frame you're looking at. Going forward, if you see, since the beginning of the new fiscal year, that's not the case. This plan's behind the general pension because markets are going up. That all credit segment makes this a much more conservative allocation, investment allocation. So if I had an issue, it would be with the all credit portion of their delegated investments and the price that we're paying for that. Is it worth it?
Yeah.
What's the total portfolio in there, percentage-wise?
It's probably about 15%. It's been lower. It's been going lower because you keep having managers blow up.
Right.
So,
Well, it's definitely not performing well.
well, I mean, it performed better in a down market than the equities did, you know, and that's what it's intended to do. The problem is, over the long term, is it,
How many down markets do we have?
yeah, you have more up markets than down markets, so, and I focus more on the long-term investing. But,
What about the mix of investments that we have through Willis Towers Watson? And I think, I remember you said there was
They each have their own stable, which one chart would
Well,
probably be more realistic.
the Willis Towers Watson and ANCO and other consultants, they typically, the way they look at individual investment managers is they have databases, and they look at and there are probably like half a dozen main databases of investment managers that they have access to. So they'll start looking at that, but then they'll meet with the managers that they think have good ideas or good investment strategies or theses, you know, the way that they make their investment decisions in different asset classes. And that's how they develop their recommendations to their clients. We have a retiree health insurance trust fund that we have sort of a wrap consulting program with Morgan Stanley with, and that's different. The managers within that program, they actually belong to this Morgan Stanley stable that agrees to have lower fees to be part of the process. Right. And I think they're lower quality managers in general, because if a manager's doing well, they don't need to agree to lower fees to be part of the process. But there's not a given stable for, you know, somebody like Willis Towers Watson, I think. They're looking at the databases and they're trying to cull the best managers that they think fit.
I just recall a discussion about they can get a better discount as a result of that.
There are two managers that they have negotiated a discounted rate over their standard rate with. I think it's Principal and More.
No, either of which.
And
Or at least is not a-
any consultant is going to do that. All consultants try to do that.
Well, I personally, I'll go however the majority goes, I don't have a strong
Well, I think
view.
that from what I've seen is the general consensus is the board members aren't interested in going to 90% equity or something like that. I know we've had discussions about whether we're paying too much for the consultant. I know that there's other managers out there we're probably not seeing because they didn't choose them, we didn't get to hear presentations. They are saving us some time here, but we have time. That shouldn't be an issue. I think it's worth getting some other quotes, RFPs, and looking at them. I don't know, do we need direction to send that?
If you tell staff to draft an RFP for you, we can do that and bring it back. And, you know, just because you do an RFP process doesn't mean you have to change your consultant. You know, you may do the process and decide that, you know, Willis Towers Watson is who you want to stay with.
Right.
The only problem I would have is could or consultant X bring you the same people that are upscale, what's in Wilson Towers Watson
That's kind of
program
what I was
does? That's
asking.
my complaint.
Yeah.
You could see overlap between the managers recommended by different consultants, but, you know, there are so many managers you may not.
Right.
And, you know, the differential there is, I mean, you've got thousands of investment managers out there, you know. So you could see some overlap, but you wouldn't necessarily see it. But typically, even if you hired a new consultant, they wouldn't come in and expect you to change your
We're gonna
managers.
change the whole portfolio.
Right,
You may
they
look
might
right.
have one or two recommendations, that's all.
All right, that's kind of what I was
Yeah,
thinking.
you're not gonna change the whole profile. You're gonna keep, like, principal's not gonna say, oh, you changed your consultant, so we have to go back to the other price. They're not gonna tell you that.
Yeah, I know companies do it all the time, they'll advertise a job that doesn't exist just to test the market, and that's, maybe we would do that.
Money-wise to the plan, does this cost us extra to send out the RFP or anything?
No.
Staff's a sunk cost, Eugene.
We'll just take it as another workload burden that we have to deal with.
Value added.
Would we like a motion on it?
Yeah, I mean, if you want us to proceed and provide a draft RFP for you to review at the next meeting, then, yeah, a motion would be good.
I'll make that motion.
All right, there's a motion for staff to draft an RFP to review at the next meeting for consulting quotes. Is there a second?
Second.
Under discussion? Hearing none. All in favor, say aye.
Aye.
Any opposed? All right, motion passes.
You know it's gonna work.
All right, next agenda item, annual report. Prisoner retirement.
So this is the report that we have to submit to the Division of Retirement every year to get the 175 and 185 share plan premium tax distributions. We have a draft of it this year earlier than we usually do because we have gotten, typically we're held up waiting for financials. But we have fiscal year 22 financial draft done, and so those numbers are included in this report. And, you know, the board used to have to approve these reports and sign it, and that's not really the case anymore, but we're bringing it to you as an informational item. You know, I mean, if the board wanted to say you approved it, it wouldn't hurt, but I don't think it's required.
Why did it change it? We don't have to vote on it, do you know?
They went to an online submission, and, you know, there used to be like a page that required the chairman's signature and secretary's signature, and now there's not. So I guess they just,
An administrative.
but I don't mind if the board wants to make a motion that you approve me submitting this to the state. It wouldn't hurt.
Well, I'll make that motion then.
All right, is there a second?
I'll second.
Under discussion, is there anything surprising?
No, I don't think so.
I hope not.
You know, I mean, we can discuss it again at the next meeting if you like. I know it's because you guys didn't receive the emails, you haven't had a chance to look at it. So if you like, take your time and look at it.
Is that part of us changing over our email system? Is that why the email didn't go through, or you said it was maybe just too big?
I don't know because,
Other emails
All right,
coming
so that, when I was doing all the changes, drafting changes to the plan to send to the city attorney, and it also had some attachments to it associated with the contract language, recommendations, stuff like that. Turns out one of the things I sent had a macro embedded in it,
Exactly, yeah.
and our server wouldn't send that through, because I kept, Michelle, you are really, really slacking, because you are usually pretty, she's very responsive. Then she said, Steve, what the hell are you talking about? And then I checked and it said sent, they were in my sent,
yeah,
but they were not in her inbox.
yeah.
So there could be something within the file that's sent that's getting held up. The macro was an example, and Gene Clark said, well, Steve, here's what.
They're looking at it, the issue, so I recreated the email and sent it to one of the IT guys who's at GRU, and he got it. But nobody else that I sent it to got it. Greg didn't get it, Steve, no one here got it, so.
Even the one I sent.
Yeah, and he recreated it and sent
Is it
it.
because he has,
So it may be an attachment, it may be something in one of the attachments, but all the attachments were either
he has no
PDFs
filter.
or the 2 Word documents that were your forms.
But this is these are the Word documents I sent to Michelle.
Oh.
So it's
You're
it's
the
inside.
problem.
It's inside this, and the macro refers back to something that's not part of the attachment, it's part of their.
We'll try to resend it without those.
Scratch the whole system.
So this is the
didn't you
this is
send-
the only common,
Just
element to
figure
the
it out.
two emails, these 2 damn documents.
All right.
Are we gonna have to sell anything to fulfill that order coming up?
I'll talk to Willis Towers Watson about it, and we'll see where we were going to try to take that
I
from.
think the cash only has 220,000, 291.
If we have to sell anything, we'll mention it to the board in March, where we would take it. We'd probably just take it from something that was either over target or, the least under target, rebalancing wise.
Did we move in second to have you send this?
But it's still under discussion.
Okay,
Okay, I wasn't, I'm just.
They were still under discussion.
heard
All right, so,
Bring it off one.
is there any further discussion?
I don't think I heard.
Take our,
Leah,
assumption.
The motion was to accept the annual report to be submitted to the state.
Right.
And it was seconded, we discussed it. Is there any further discussion?
We already did the assessment.
This is
The assumption. They're gonna come back and say, oh, your earnings should be this.
Well, we did, they replied that they received that we changed it to 775.
Yeah, so
Have they given
in the
any
past,
feedback?
we just said, when the board approves the actuarial val, that includes our expected investment return assumption. But now they're saying you have to send either a second document or a separate document or email stating that's what it was. And so I just created one based on, actually ANCO, the consultant for the general pension, they do that at all their board meetings. And I talked to the actuary. Foster said you should probably talk to ANCO about it because they work on a lot of other Florida plans. And I just copied exactly what they had sent, and it was accepted. So we're good.
See, I don't see, like, that was a year and a half ago with the right share plans.
Yeah.
This needs to be filed by time certain, and the release of premium tax is tied to filing the report.
So their official technical deadline for receipt is March 15th. We often have this report approved at the March board meeting, so it often in the past has been sent, at the end of March or beginning of April. They don't have a problem with that.
No, they wait till
Yeah.
a month
Last
after.
year, we
A
didn't
month
do-
after the fiscal year's over to tell us that they didn't like something.
Right. Well, it depends on when you submit it. So, you know, we typically.
We're gonna get first in line because we're getting in before a deadline.
Yeah.
Well, you got the financials in place now. That's,
Yeah,
that's the big,
That's the big thing.
that's the big thing.
And last year, I don't think the report got submitted until probably August because we didn't have financials.
Yeah, in fact, we had, yeah.
All right, is there any other discussion? All in favor of accepting the annual report for the state, say aye.
Aye.
Any opposed? All right, the motion passes. Next item, one quick thing completed, just so you know, this, when Bruce was on the board, he had made some complaints that some forms had changed, that risk management, nobody knew about it. There was a discussion about everyone, like, was a
And
discussion
everybody get off by law.
about the board having to approve all changes to forms, and at the end of the day, what the board motion was that the board be notified when retirement forms are changed, not that we vote on it.
Okay.
And so I knew we were changing these drop stuff, so I asked if Steve and they would bring a copy. I still think, will the military and buyback be affected by the ordinance change? I haven't seen one in a while, I don't remember what all it states about.
We'll just say, the certification's the same. You're certifying that the time year meets the definitions of the plan. So we'll have to tweak the out-of-state.
That might need, something might need to
Yeah.
change.
But it's usable even as it is.
And do those forms designate the repayment period?
Yes.
Because we did talk about that.
Mhm.
What's the period of time?
Depends on how much you're buying.
Oh, okay.
And that's only if you finance it through the plan. Otherwise.
If you finance it, it's at our assumed rate, it's 7.75,
So.
which actually is probably not bad right now.
So it's, for 1 year, you have 24 months, I believe, 2 years, 36.
I think it
But
had
that
it-
caps it. It does cap at
4 or
4
5
years.
Yeah,
Mhm.
something like that.
So, yeah, we don't have many people
Could you forward
financing
me?
it through the
Could-
plan.
Can I check on Melissa, or can you forward me a copy of the current one?
Sure.
If I have it on binder.
I'm sure we have it somewhere. It's been so long since somebody's bought time.
All
Is
right.
it on the intranet?
Maybe.
Some of those other forms are there.
I don't know.
Okay.
Because it's so,
Rare.
yeah.
All right, I misplaced my agenda, but next item was public comment. Do you have any public comment?
Yes, my name's Donald Shepherd. A lot of you know me, but my comment is I'm worried about the windmill situation killing all those whales and how with NASCAR and AMCO out there looking at this and what's their feedback towards the financial picture of that type happening in the future.
Some things change in some sense or
You say AMCO? AMCO?
Yeah.
So ANCO is the consultant for the general pension plan. Willis Towers Watson is a consultant here, but we can have a discussion with them about that.
Okay. That's all I had. But I'd like to also ask for copies of everything so that I'm more impressed with everything that we have done today.
Yes,
There's one
sir.
right there for you, Don.
Okay.
Expect a complete summary next week.
Thank you all.
And that
Thank you,
packet
sir.
right there.
Thank you. Everything's got everything.
Thank you.
Thank you.
All right, the next
Where we
meeting is March 22nd, 0900, same location.
Left out number comment.
Is it on it? I thought that's what we've been doing. I lost my agenda.
I don't want to hear
We're gonna get a.
All right, is there any further member comment?
No.
We have pretty much have an open forum all day. Next meeting's next month, March 22nd. Motion adjourned is in order.
Motion to adjourn.
All in favor?
All right.
Bye.
Any opposed? All right, meeting's adjourned.